Welcome to this week's Forex forecast for the week starting January 6, 2025. In this video, we'll dive into the latest market trends, key economic events, and major currency pairs to watch. Whether you're a seasoned trader or just getting started, this forecast is packed with insights to help you navigate the Forex market. From the US dollar's reaction to upcoming NFP data to the euro's momentum amid ECB developments, we've got you covered. Stay tuned as we break down the technical levels, market sentiment, and predictions for the week ahead. The US dollar, USD, enters the week with mixed momentum, reflecting the tug-of-war between robust labor market data and cooling inflation signals. The Federal Reserve's December meeting minutes, scheduled for release midweek, will be crucial in shaping market expectations for future rate decisions. While the Fed remains committed to its inflation target, signs of economic resilience could prompt hawkish tones, supporting the USD. However, traders will closely watch Friday's Non-Farm Payroll (NFP) report, which could be a market mover. If job growth beats expectations and wage pressures remain elevated, the USD may strengthen against major currencies. Conversely, weaker-than-expected data could raise doubts about the Fed's ability to hike rates further, potentially triggering a sell-off. In addition, geopolitical risks and shifting global risk sentiment may further influence the dollar's trajectory. Overall, volatility is expected, with the USD likely to react sharply to data releases and central bank commentary throughout the week. Starting with the euro, the currency is showing some strength as we move into this week. The European Central Bank, ECB, has remained hawkish, and that's been a major driver behind recent euro gains. The big focus this week will be on the Eurozone's inflation data and the ECB's meeting minutes, both of which could give us important clues about future monetary policy. If inflation remains stubbornly high, expect the euro to continue finding support, potentially pushing euro to US dollar above the key resistance at 1.1000. However, any sign of slowing growth in major economies like Germany and France could limit upside potential. Technically, a breakout above 1.1000 could lead to further gains, but if data disappoints, we could see a pullback to 1.0800. The euro is entering the week with a bullish undertone, supported by recent hawkish commentary from European Central Bank (ECB) officials who remain focused on tackling persistent inflation. The spotlight this week will be on the Eurozone's December inflation data and the ECB's meeting minutes, both expected to provide clarity on the central bank's rate hike trajectory. If inflation remains stubbornly high, the euro could find further support as markets price in prolonged monetary tightening. However, slowing growth in key Eurozone economies, particularly Germany and France, could temper optimism and weigh on the currency. Additionally, any unexpected weakness in retail sales or industrial production data could dampen the bullish sentiment. Technically, the euro to US dollar pair is testing critical resistance around 1.1000, and a breakout above this level could signal further gains. On the other hand, if data disappoints, a pullback toward the 1.0800 support zone is likely. With market volatility expected, traders should stay alert to both data releases and geopolitical developments that may impact the euro's performance this week. Next, let's talk about the British pound. The pound is facing some serious headwinds this week, mainly due to concerns about the UK's slowing economic growth. We've already seen weaker-than-expected data, and traders will be eyeing UK retail sales and GDP numbers for further insight. If these figures show resilience, we could see some support for the pound. But if the data disappoints, expect the GBP to remain under pressure. Technically, pound sterling to US dollar is hovering near the key 1.2500 level. A break below 1.2400 could open the door to further declines, while resistance sits around 1.2650. The British pound, GBP, faces a challenging week as concerns over the UK's slowing economic growth continue to weigh on sentiment. Last week's weaker-than-expected data highlighted the strain on the economy, leaving the GBP vulnerable to further downside risks. This week, traders will focus on key UK data releases, including retail sales and GDP estimates, which are expected to provide insights into the health of the economy. If these figures show signs of resilience, the GBP may find some support, especially against weaker currencies. However, any indication of a deeper slowdown or persistent economic struggles could push the pound lower. Additionally, the Bank of England's cautious approach to monetary policy may limit the GBP's upside potential, as markets remain unconvinced about the likelihood of additional rate hikes. Technically, pound sterling to US dollar is trading near the critical 1.2500 level, with resistance at 1.2650 and a key support zone around 1.2400. A break below this level could open the door to further declines, making it a pivotal week for the British pound. Stay tuned to both domestic data and broader risk sentiment, as these will likely dictate the GBP's performance in the Forex market. Moving on to the Japanese yen, the JPY remains under pressure due to the Bank of Japan's ultra-loose monetary policy. The BOJ has shown little sign of tightening, which keeps the yen weak against major currencies. This week, the BOJ's meeting minutes will be in focus for any hints about future policy changes, but we don't expect much to shift. Risk sentiment will play a huge role in yen moves. If global markets stay bullish, the US dollar to Japanese yen could continue its upward momentum, testing 150.00. Any signs of risk-off could bring the yen back into play as a safe haven asset. Technically, support sits at 148.50, and a break above 150.00 would signal further upside for US dollar to Japanese yen. The Japanese yen, JPY, continues to face pressure from the Bank of Japan's, BOJ, ongoing ultra-loose monetary policy, which shows little sign of changing in the near term. The BOJ's commitment to keeping interest rates low, even in the face of rising global inflation, has kept the yen weak compared to major currencies. This week, market attention will be focused on the BOJ's minutes from their latest meeting, which could provide further insight into their stance on inflation and future policy actions. Despite any surprises from the BOJ, the yen's movement will largely depend on global risk sentiment, as investors continue to flock to higher-yielding currencies like the US dollar and euro. Technically, US dollar to Japanese yen remains bullish, with the pair eyeing the 150.00 level as the next resistance target. If risk appetite improves and global equity markets continue their upward momentum, the yen could weaken further. However, any unexpected shifts in market sentiment or changes in the broader economic outlook could prompt a corrective pullback towards support at 148.50. Overall, expect continued volatility for the yen, with fluctuations driven more by global trends than domestic developments. Now, let's look at the Australian dollar. The AUD is heavily influenced by commodity prices, particularly oil and metals. This week, all eyes will be on China's PMI data, as the Chinese economy is a major driver for Australian exports. If China's data shows signs of improvement, the Aussie could find some strength. However, if global risk sentiment weakens or China's recovery stumbles, the AUD could face pressure. Technically, Australian dollar to US dollar is trading near 0.6500. A break below 0.6400 could lead to further downside, but if the Aussie gets a boost, resistance is seen around 0.6700. The Australian dollar AUD is facing a delicate balance this week as commodity prices and risk sentiment continue to play a significant role in its performance. The Aussie has been closely tied to global demand for key exports like iron ore, coal, and natural gas, making it particularly sensitive to developments in China, Australia's largest trading partner. This week, market participants will be watching China's PMI data, which could offer clues about the state of the Chinese economy and impact the AUD's direction. On top of that, Australia's trade balance figures will be key in gauging the health of the economy. If exports remain strong and global demand holds steady, the AUD could gain momentum. However, if global risk sentiment weakens or China's economic recovery shows signs of stalling, the Australian dollar could struggle to hold its ground. Technically, Australian dollar to US dollar remains under pressure around the 0.6500 level, with further downside potential if it breaks below the 0.6400 support. A rebound could bring the pair back toward resistance at 0.6700, but this will depend largely on external factors, including commodity prices and global market sentiment. Keep an eye on China's economic data and broader risk appetite, as these will likely dictate the Australian dollar's movements in the week ahead. Lastly, let's talk about the Canadian dollar. The CAD's performance is closely tied to oil prices, so we'll need to keep an eye on the price of WTI crude oil this week. If oil continues to show strength, the Canadian dollar could get a lift. We'll also be watching Canada's jobs report on Friday, as any positive data could push the CAD higher. On the flip side, weaker data or a pullback in oil prices could weigh on the CAD. Technically, US dollar to Canadian dollar is testing 1.3700, with support around 1.3500. A break above 1.3700 could lead to further upside for US dollar to Canadian dollar, while a pullback to 1.3500 could offer a buying opportunity for the Canadian dollar. The Canadian dollar, CAD, is expected to be heavily influenced by oil prices and risk sentiment this week, as the commodity-based currency remains tightly correlated with movements in crude oil. With oil being Canada's largest export, any fluctuations in global oil prices will have a direct impact on the CAD. Traders will be monitoring the price of WTI crude, which has been experiencing volatility in recent weeks due to global economic concerns and OPEC+ decisions. If oil prices continue to show strength, the CAD could see upward pressure. Additionally, the Canadian jobs report set to be released on Friday could provide further insight into the health of the Canadian economy, potentially boosting the CAD if employment data is stronger than expected. However, if the jobs data disappoints or oil prices take a hit due to global demand fears or geopolitical tensions, the Canadian dollar could face significant downside risk. Technically, US dollar to Canadian dollar remains bullish, testing the 1.3700 resistance zone, and a break above this level could push the pair higher. On the downside, support is seen near 1.3500, and a pullback to this level could offer opportunities for a bounce. Overall, expect the CAD to remain sensitive to oil price movements and global market sentiment, with volatility likely to remain elevated throughout the week. So, there you have it. A quick rundown of the euro, British pound, Japanese yen, Australian dollar, and Canadian dollar for the week ahead. As always, make sure to keep an eye on key economic data, central bank meetings, and market sentiment, as they'll play a crucial role in shaping price action. If you found this video helpful, don't forget to hit the like button and subscribe to the channel for more Forex insights. Also, drop a comment below if you have any questions or if there's a currency pair you want us to cover next week. Thanks for watching, and I'll see you in the next one.